Welcome, one and all, to the week 6 recap for the Rebel Finance course. So we are going to look at the investing side of things, or what it all means about investing and stuff. So investing is sexy. Is it really sexy, or is it more along the lines of this sort of chap sexy? Is it geeky sexy? This obviously take your pick. Just a quick recap on what we've covered before. Last week, we looked at basically values and beliefs. So we asked in the homework to sort of look at how you felt about stuff, where you were on various scales, whether you were a spender or a saver, looked at the past or the future, and all those sorts of things. To look at those around you and see whether they were sort of supporting you in what you were trying to achieve, or if they weren't, was there somewhere that you could get people who are and do want to support you in your journey? And we suggested that if you don't have anybody immediately available to you, then do look on the Facebook group and post on there to find a buddy. Quick disclaimer again this week, I'm not a financial advisor. This isn't regulated. It's not financial advice. It's just literally, what I've picked up, what I've learned both from Alan and Katie and through my own research. Your own research is really, really important so that you understand what it is you're sort of getting into. I'm not going to sell you anything. It's all your own choices as to what you are doing, and these are merely opinions and ideas. And a big thing to remember is that investments can and indeed will go down in value as well as up, as we have seen over the course of the last year, especially. So the foundation stones to remember as well is how to get wealthy. Conscious expenditure is key, which is basically understanding that, yeah, spend money. The whole thing behind this is it's not about deprivation. It's about creating a lifestyle that you're happy with, doing things that you want to do, but understanding the true full cost of it. And that when you are spending money, then you are essentially signing up for working longer, because you've got to earn that money back again. Increase your income and invest the difference in assets. So reduce your outgoings if you can, increase your incomes if you can, and then invest the difference in assets. So everybody go out there and spend, but you want to go out there and you want to buy. And what is it you want to buy? You want to buy your freedom. So first thing to do, I would advise every month when you get your paycheck in whatever form it may be, is that some of that you put into savings, because if you pay yourself first, it's much more likely to happen than if you sort of wait until the end of the month and say, oh, I've got a little bit left. And it's like, oh, okay, I've got a bit left. Shall I go out for a night with my mates, or shall I buy a takeaway, or shall I save it? Because we as a general species are very much into instant gratification rather than delayed gratification. But believe me, it is worth putting something aside. So yes, if you have money at the end of the month, what do you do with it? Well, buy assets and not liabilities. So I'm going to look now at what an asset is and all those sorts of things, and particularly in terms of investing, what we look at assets to be. But before we get to that, if you have to buy a liability, then as it says, buy a small one. So yeah, don't go out and buy a Lamborghini, which is going to cost you loads and loads of money, both to buy in the first place and then to maintain it. Unless, of course, you've got an income that will support that quite happily while still putting money aside to invest. Instead, get something, practical. Maybe a Citigo is a little bit too small for you. You need a family car, or you need something a bit bigger. But what I endeavor to do is to buy the smallest thing that will provide me with the things that I need, in order to do my daily tasks, in order to get around, in order to spend time with family, basically in order to go in line with my values, um, to achieve what I want to achieve, and not sort of reduce the lifestyle that I want to live. Sorry, someone who's just joined, I think, is not muted. Let's see. I'm just gonna quickly mute everyone. There we go. Right. Okay, so buy small liabilities if you have to buy liabilities at all. And that, actually, I must just, coming back to a point there, that does include housing as well. If you're going to buy a house, then consider what purpose it is going to fulfill and what you want it for. Is it literally just somewhere to live whilst you raise the family, and then once you've done that, you're going to, move on, downsize or whatever? Is it something that you want to buy to potentially extend, to try and get some extra value out of? But the one thing I would suggest with property is that you do sit down and do some calculations before you buy one, rather than renting one, because sometimes it actually works out more favorable to rent. If you're going to be in a property for less than 5 years, rental might actually work out better because of all the costs involved with buying and selling and all those sorts of things. So there is a bit of a paperwork exercise to do around housing. So asset classes, what are they? Well, we have these things called equities, which are stocks and shares, as opposed to the equity you have in your house, which is the difference between what you owe and what you own on your house. There we go. Then we have bonds, which bonds are basically a slip. They're almost a loan. They're like you're loaning somebody some money, and they pay you back a certain amount of interest on it over a certain period of time. The thing with bonds is that they're usually for a minimum period 3-6 months, or they could even be up to sort of 5, 10, 15, 20, even 30 years. You can get long-term bonds, but they're great for providing a regular income, and some people do recommend them as you get close to retirement to sort of balance out the variability in the stock market. But it's one of those things, they're not great for returns at the moment. So I think you can actually get more in just some of the instant saver accounts. So bonds are an interesting area. Money market interest, so like what you can get in your bank account. Asset classes, real estate and housing. When is it an asset and when is it a liability? When you are living in it, it's a liability. It's costing you a lot more than it's providing you in income. If you've bought a property to rent out, or maybe if you're renting out a room in your house or something, and it is providing you with more income than it is costing you, then it is an asset. So if you've got an Airbnb property, if you've got, I don't know, a bit of woodland with some camping, then that's essentially an asset, as long as it's providing you with some income. And those sorts of things. You can actually buy real estate in bits on the stock market. There are various sort of real estate options that you can buy on there, which is a much more flexible way to do it, because obviously if you buy a property, trying to sell it could also be quite problematical. I mean, I lived in a property at one point, and it took almost 2 years to the day to sell it. So it's not exactly what we would call liquid. Whereas if you buy real estate sort of options within the stock market, then those generally you can trade back and forth on a daily basis. There is a lot of jargon in the finance world. They like to try and make it complicated to justify some of the horrendous fees that they like to charge you. However, with a little bit of work, it's easy enough to sort of understand what's going on. So look at it see what there is, and if there's anything at all that you don't understand with the stuff you're looking at, then just post a question into the group, and someone will come back to help you. There's a lot of very good help on there. So understand what it is that you're doing before you sort of get into it, so that you don't make any costly mistakes. Okay, I think all those bullet points are pretty self-explanatory. So yes, do come and ask questions. As it said, as Einstein said, indeed, there are no stupid questions, only stupid people. And those people are the ones who do not ask the questions that they need to know the answers to. The next important thing to say about investing, which is the rule that I should follow, and I'm not always very good at following, is diversification. You spread things out. Don't stick everything into one particular marketplace, one particular fund, or anything like that. So diversification is not picking one company to invest in. So, even if you work for the greatest company in the world, I don't know, say you work for Apple, or Tesla or Google or any other sort of great company that's done well on the stock market, picking just that company to invest in. You work there, you get your stock options, and then you go and buy more shares in that company. Not necessarily a great thing to do, because those shares could all drop in value, and you could get wiped out pretty easily. Don't put them all into one particular industry either. So I think African mining stocks was an example from J.L. Collins's early days of investing, where he didn't do very well there. Myself, yes, I love green tech and everything, so I went and chucked a load of money into electric vehicles. So I put some money into Tesla. That is currently down 11%. I put some money into a company called Rivian, who are another fantastic electric vehicle company. The investment I put into there is currently down 85%. I also put some money into this van company called Arrival, which has got hundreds of thousands of pre-orders from Amazon and DHL and various other people for their trucks and vehicles. The stock is currently down 94% from where I bought it. Fortunately, I didn't put too much into those. I put in enough for it to hurt, but yeah, fortunately, the majority of my holdings are in Vanguard stocks, which we shall take a look at in a minute. But before we get to investing, when should you not invest? Quite simply, when you need the money. If it's money you are planning on spending, if it's money with a time span of less than 5 years that you are going to want to use it, generally it's best not to stick it into the stock market. And even 5 years is a semi-risky time span. In order to sort of guarantee you will make money, well, guarantee, statistically, based on historical activity, although what has happened in the past is not a guarantee of what will happen in the future, statistically, you really want to hold something for more than 10 years on an index fund in order to ensure that you will break even or make money on it. So if it's anything less than 5 years, I would probably steer clear of it and just find the best interest-bearing account that you can for the moment. Do not invest if you think you will panic. The market will go down anywhere from a couple of percent to 60-70%. It will take these drops at times. It is part of the cycle that it all goes through. And if you think that you will panic when it drops and sell out, it's probably not the place that you want to be, because generally, historically, it has always recovered again, and gone up. So you need to think about a whole bunch of things, and generally you need a mindset that you're happy with essentially losing on paper or that some money, but as long as you keep it there, as long as you don't sell it, then it will over time come back up again, mostly. Certainly on an index fund anyway. If you stock pick, then there's every chance that it will go down and stay down and potentially even go to nothing. So make sure that you've done all of the previous steps as well, especially your emergency fund, especially paying off debt, and also knowing how much you need every month and how much you've got left to sort of pay yourself first. So yes, it's you're in this for the long haul. So don't race, just put it in, track your net worth and all that sort of stuff. Now, there are plenty of ways to create a path to becoming financially independent. Everything from starting your own business to investing in property to doing loads and loads of other things. So why in particular stocks? Well, quite simply because of the time it gives you and the amount of time it takes to do it. If you look at investing into a tracker fund, okay, it's not particularly sexy, it's not particularly racy, you know, and it won't go through making massive leaps in gains like you could potentially do from picking an individual stock. But it is much, I would say it's much safer on a long-term strategy for having consistent returns over, you know, over a decade or so. And you can do it pretty much from anywhere in any condition. Whereas if you were to have a house or an Airbnb property, you know, you've got to look after it, or you can pay people to look after it, but then you don't get such great returns on it. So it's one of these balance things. And even if you do pay people to look after your property, are they going to do it properly? Are they going to do it to the standard that you want them to? So there's a lot more worry involved in other things, in my opinion, or in how I feel. And also, you can start small. I think it says here £100 or $100. I think you can actually now start on some accounts with only £25 or $25. So you don't have to have a whole load of capital in order to get started in the first place. So if we were to look at the range of things from passive to active, kind of slightly on the active side, we've got a self-managed property. So you own a house, then you rent it out and you've got to look after it. More towards the passive side is when you manage it. But as I said, you've got to pay someone to do that. So your returns are lower. More active is running your own business. Now, that can be on a sliding scale. Certainly when you start up, it is going to be very active. You are going to have to dedicate time and effort and everything into that business. However, over time, as you take on employees and then maybe take on a manager, a CEO, and that sort of stuff, you might find it moving more and more towards the passive end of the scale, whereby you can hand it over to somebody else to manage. But you'll probably always be involved in it until such a point as maybe you sell the business, but just retain some shareholding in it, and you know, get some money from it that way. The most passive thing you can do really is index funds. I mean, they're literally just buy and forget. So the three main ways to invest in the stock market is the stock picking, which I said, not very good idea. Actively managed, which is kind of balanced between you stock picking and going with a passive, an index fund. An actively managed fund is where you essentially pay people to stock pick for you. And in theory, they know better what they are doing. However, as is famously shown by a bet that Warren Buffett had with some friends, he put up $1 million into an index fund and said to his mates, okay, you can take your money and invest it into whatever you like, change it as much as you like, and then after a period of time, let's see who's got most money at the end, and then, you know, whoever loses, they've got to give their money to charity, sort of thing. And needless to say, the active fund, yeah, it performed better at some points and then it performed worse. And over the period of time, it performed worse overall than the index funds. So it was as expected to lose. So actively managed funds, yep, they may do great to start with. However, generally over a 5-year or longer time span, an index fund will outperform the majority of the managed funds. The other thing to know is that managed funds charge you a lot more. So they have to make a lot more before you actually get to see the benefits of it. So an index fund basically contains a whole load of shares. So probably two of the best known sort of index funds, if you like, are the FTSE 100 and also the S&P 500. So the FTSE 100 is a UK based sort of index, which is based on the FTSE Financial Times Stock Exchange in London, and the S&P 500 is based on the Standard & Poor's sort of 500 biggest companies in the US. Certainly the S&P 500 has performed very well. The FTSE 100, not so good over the last sort of 10 years, really. But the index, a true index fund, doesn't contain 100 stocks or 500 stocks. It contains way more than that. But you have a whole bunch of things. So, for example, on the Vanguard, the FTSE Global All Cap Index Fund, so this is tracking a whole bunch of funds. In fact, you can see it's tracking over 7,000 different stocks in this fund. Now, this was a slide that I made back in 2022, and at the beginning of 2022. I've just checked the updated details on this. And as you can see, the price has only gone up slightly, but it has gone up a little bit, which isn't bad considering how much things went down over the last few months, that it has recovered to that level. And this kind of goes on what I was saying earlier, that the stocks will go down, but they generally recover, and they have done. There's slightly fewer stocks in it at the moment than there was, but the management fee is 0.23%, which is pretty good. Anything below about 0.3% is a good fee. So the FTSE, the second of the Vanguard funds that I use is a FTSE Developed World excluding UK. So that first one had UK stocks and shares in it. This one doesn't have stocks and shares in it. It's also slightly more focused on what it's invested in. As you can see, it's only got just over 2,000 stocks in it. It does have a slightly lower management fee of 0.14%. And the updated price on this is it has gone up by slightly more than the other one did. Now it says change on there is minus £2.18. That's just over the day, so you can ignore that. Again, slightly fewer stocks. And the final one is as you can see, is the FTSE 100, which only has 102 stocks. That one, surprisingly, doing slightly better. Now, one reason why that might appear to be doing better is due to exchange rates, because those other two funds both have a lot of stocks in them which are valued in dollars. And at the moment, the pound is getting slightly stronger against the dollar, which means that the value of dollar shares is sort of gone down a bit in comparison. So that's why the sort of growth on that side of things doesn't appear to be as much as the FTSE 100 at the moment. But generally, the other funds will outperform the FTSE 100 fund. But yeah, as I say, at the moment with the with the exchange difference on the currencies, that was it. Yes. So what is the difference between active and passive? Well, active, as I said, is basically how you stock pick, or you have a manager stock pick for you, and generally they don't do great. The people who tend to do the best are those who have bought their stocks and then forgotten about them. And yeah, in the Fidelity study, the people in the cemetery tended to do the best because they would literally buy a bundle full of stocks and then just leave them and forget about them. Obviously, they can't really trade when they're sitting in a box 6 foot down, although I'm sure with the way technology is improving, that may change in the future. And a quick look on how important it is to encourage people to start as early as possible. I appreciate that some of us here aren't quite as young as Ellie and Larry here, but it is still worth doing something. So, for example, Ellie, if she starts at age 20 and just puts some money in for 10 years and stops, so investing, say, £12,000, starting from age 20, but someone else waits until 10 years later and then puts in the same amount for 3 times as long, so invests 3 times as much money, who would you expect to have more? Would it be Ellie or Larry? I mean, Larry's put in more, so surely he'd have more out at the end. Well, actually, no. Larry's invested £24,000 more, but actually ends up with £143,500 less by age 60, working on sort of an average return. So as you can see, if you have children or grandchildren, it's well worth encouraging them to put aside a little bit as early as they can. For example, with my 2 eldest children, when they were born and we were getting the child benefit, we didn't need the child benefit payments because I was earning reasonably then. So we actually opened pensions for both of them and put the child benefit payment into their pension funds. So I mean, there wasn't a huge amount that went in. I think it was only probably about £3,000 to £5,000, but with the growth, it looks like it's going to be worth about 150,000 by the time they get to retire. So it's, yeah, time definitely wins when it comes to investing. So let's have a look actually how active investing would have affected Ellie's return. Now, this is assuming that all the funds perform the same. So this is just looking at how much more Ellie would have paid in fees if she'd have gone with an active investment rather than with an index fund. So, where have we gone, Ellie? Come on. Ellie doesn't want to show us. Oh yeah, here we go. It's a slow building graph. So as you can see, it starts off pretty similar for the first 10 years, but as time goes by, we can see gradually an active fund at the bottom there is causing a bit of a divergence. So after 20 years, whereas Vanguard or no fees has passed over 50,000 worth of value, the active fund takes until about 44 to get to 50,000. So that's like 4 years later, but then the compounding starts really taking effect. And at about 47 and a half, Ellie's through 100,000 with her low fees, but with the active fees, it's nowhere near. So, you know, through 150,000, I mean, we're what, up to about 175,000 before the active account even gets to 100,000. So let's see if we can, there must be a way to speed this up. It's supposed to go faster. Ah, dear. Come on, build. But yeah, I mean, there we go. With Vanguard fees, Ellie's through 300,000, whereas the active fees are like 150,000. So after 40 years, there is a difference of £170,000, all based on the extra fees that have been paid for an active account. Now, I don't know about you, but I'd rather have £170,000 extra in my pocket and invested into my funds than having given it to somebody else for a fund which potentially will not have performed as well as an index fund, certainly over a period of 40 years. But then we come to this never bothered Ned with his big zero. I mean, basically, if you don't stick anything in, you won't get anything out. And something has to be better than nothing. So a quick quote from Warren Buffett. That's Warren smiling there. Essentially, patience wins out. Stick the money in, forget about it, and just wait until you get to your FI figure, which you'll know from doing your net worth tracking, and all will be good. Sorry, excuse me. So that's pretty much it for today. And there's a little bit of homework if you fancy doing it. First of all, read the articles about the index investing that Alan did. Alan Katie did. It's all about diversification and all that sort of stuff. And also have a look at what you currently have. What are your pensions, either from your employers or your personal pensions and those sorts of things? What are they invested in? What are the fees? Are they active or passive, and all those sorts of things? Do you have any choice over where they're invested, and how can you maximize them? How can you make sure that if your employer offers a matching scheme, that you are getting the best value out of it? There's all sort of little tweaks that you can try to see. So there we go. Don't be normal, be an example.